Hey, good morning. We're going to give it another probably 60 seconds here before we get started and let everybody kind of populate into the room here. But happy Wednesday. Okay, good morning. We are really excited to have you all here today. We had probably a record number of people sign up for this webinar, but annuities are a really hot topic right now. Given the interest rate environment, the volatility in the markets, kind of going into an election year. So we're going to cover, quite a bit as we go through this today. So here's kind of what we're going to cover. We're going to talk through annuity basics, how they work, the benefits and risks of different annuity options. There's several different types of annuities out there on the market, depending on what the solution is that you're looking for. We're going to go into some real life client case studies and just talk through a few different situations that match some of the goals and objectives that some of our clients that we've worked with had when they were looking at annuities. We're also going to talk about today's top paying annuity companies and products. I'm sure a lot of people are wondering, what today's rates look like. If you're looking for, income generating annuities, what those payout rates are. So we'll spend a little bit of time talking about that. And then lastly, some steps to evaluate whether an annuity is right for you. Annuities are not always the correct, financial solution, depending on the goal and objective that you have for your money. And then we'll save a little bit of time at the end for Q&A there. So just real quick, a little bit about leverage. We're a leading distributor of annuities, life insurance, and long-term care. Ultimately, we are completely independent, meaning that we're not tied to any one insurance carrier or product. We have over 30 different top-rated insurance carriers that we work with. So we're able to shop the market, find the best, the best rate and product for the clients that we work with. We operate in all 50 states, and we're ranked one of the top online annuity companies by Consumer Voice. So real quick, we'll meet our panel here. So Rhett, I'm going to go ahead and let you, introduce yourself, talk about your background and experience with annuities.
Yeah. Again, appreciate everybody jumping on this today. My name is Rhett Stubenduck. Been in the insurance and financial services field essentially my whole career, 15 plus years. Licensed in all 50 states. Located here in Omaha, Nebraska. Me and my wife have two children, a 10-year-old daughter and a 5-year-old son that keep us extremely busy. Really enjoy working with our clients as they're transitioning. A lot of our clients are transitioning into their retirement years and like working through that with them to really solidify, that last part as they saved up their assets and making sure that, we kind of take that burden off their shoulders and, help them kind of navigate that part of their life. So look forward to it today.
Awesome. Hey, thanks, Rhett. And Carly, can you introduce yourself?
Yeah, absolutely. I'm Carly Smith. I'm also here in Omaha, Nebraska. Relatively new to leverage. I joined about 2 months ago, but for all of my career, I have been in the financial services space as well. 9 years of experience doing retirement income planning, life insurance, and annuity work. I have my Series 7 and 63, as well as my life, health, and annuity license. And yeah, thanks so much for joining us today.
Awesome. And my name is Colin. I'm going to play moderator today as we kind of go through the agenda that we have laid out. But I have over 15 years of experience in financial services and insurance planning. Also licensed in all 50 states and have been around this space for a while. So Carly, as we jump in here, I want you to kind of kick us off here with annuity basics. What are they? How do they work? A lot of misconceptions. Walk us through this.
Yeah, absolutely. So annuities are a type of insurance product. They're designed mainly for, long-term financial planning or just ensuring that you do not outlive your retirement savings. You can take income from annuities when you retire. The money within an annuity grows tax deferred, meaning you do not pay taxes on the interest until you withdraw it from the policy. And as I mentioned, when you go to retire, you can convert your annuity into a guaranteed stream of income for either lifetime or for a certain number of years. And then depending on what type of annuity you purchase, there's also some additional benefits. Like I said, the lifetime income, protection from any market risk or loss, death benefits, income guarantees, and then some liquidity within those products as well.
Awesome. And thanks, Carly. Now, Rhett, walk me through, when we think about annuities, we've got a lot of different options where, people can put their money. Kind of talk through and compare annuities relative to, other options that are out there.
Yeah, so as you can see, annuities kind of check the box on a lot of these topics that people are looking to do, and kind of the other products that are out there that we're comparing against: CDs, stocks, bonds, mutual funds. So protected monthly lifetime income. Obviously, we're able to do that with annuities in a couple different routes that we're going to dive into a little bit deeper later. Protection from market risk. I think that's the biggest one that we're seeing now. People feel like there's a lot of volatility in the market, not sure kind of where we're going. Annuities are a great fit for that, whether we're looking at fixed index annuities, which we're going to touch on, or fixed rate, or what sometimes people call fixed rate, or what are referred to as MYGAs, multi-year guaranteed annuities. Tax deferral is also a really big one that we see with annuities. All your growth, like Carly mentioned earlier, is tax deferred inside of that annuity. A lot of things that we're doing is moving money from an IRA or 401k into an annuity as people are going in or getting closer to retirement because they want that protection from the market risk. And we can continue that tax deferral. Again, different types of income solutions that we can do with an annuity. And then access to the money. A lot of times when we hear about annuities, people think that you don't have access to those funds, but there's different things that we can do in structuring a policy to make sure that you still have access to that. And then guaranteed death benefits. In the event of a death, most of the companies, and I'm going to say most, and that's why it's important to work with an experienced agent, because there are annuities out there that would require like the beneficiaries to continue on that policy even after a death. And so if that's a concern that we have, we definitely want to make sure that we're getting that client into a product that is completely surrender free or surrender penalty free in the event of a death. But death benefits can be a great avenue with an annuity to make sure that we're passing on that money to where we want that to go: loved ones, charities, things like that.
Awesome. Rhett, you mentioned, MYGAs, you mentioned fixed index annuities, fixed rate options. Let's jump into, the different types of annuities, kind of the broad categories and what fall underneath each one. Carly, can you walk us through that?
Yeah, absolutely. So Rhett had touched on a couple of these and we will go into more depth, but high level, there's two types of annuities that we'll be focused on that are built primarily for accumulation: the MYGAs, the multi-year guaranteed annuities, or the FIAs, the fixed index annuities. Zero risk, no fees associated with those types of annuities. Really, you're just looking for a return on your investment without, the downside protection. So then there's three types of products that are built primarily for income. You've got the FIAs, the fixed index annuities with guaranteed income, and then SPIAs and DIAs. SPIA is a single premium immediate annuity, and a DIA is a deferred income annuity. So just looking to maximize your income for retirement, and we will be going through all of those in more depth upcoming. So Colin, if you want to jump to the next slide, we'll go through MYGAs. The multi-year guaranteed annuity, this is a pretty simple, straightforward type of product. They're going to give you a guaranteed rate for a guaranteed number of years. That interest grows tax deferred within the annuity. Again, you just aren't paying any interest tax on that until you take it out of the policy. They are backed by the insurance company themselves and considered a low-risk investment. Like I said, pretty straightforward, no fees, pretty clear terms. Most companies will allow you access to your funds, so there is a sense of liquidity. They'll either give you the interest each year or 10% depending on what product you go with. And then Roth conversions. Select MIGAs will allow you to do a Roth conversion within the annuity, which just allows that growth and the withdrawals when you take them out to be completely tax-free.
Awesome. And Carly, kind of talk through, you know, the term on these types of annuities, what rates look like today, what drives, you know, interest rates for these types of products.
Yep, so these rates can change, and we have seen that happening over the last couple of weeks, specifically just because the market is, kind of up and down. So they do change, according to the market, but once you lock in that rate, that is what is guaranteed for the term. We put a list together of the highest paying 2 through 10-year term annuities. You'll see the lowest that we've got is the 4-year paying 4.95% right now. And then the highest, we've got the 3 and the 5-year paying 5.6. So we're kind of hovering around that 5 to 5.5 range right now. And then on that very right column, you will see the liquidity that we were mentioning. Certain companies allow you to take out the interest or 5%, but then you'll see the 3-year and the 9-year. There are some companies that do not allow any withdrawals. But again, it's just whatever type of product you get into in the terms of that annuity.
Awesome. And then kind of continuing down the accumulation path here, Rhett, can you walk through kind of the basics here of fixed index annuities?
So fixed index annuities are what I would call like a hybrid plan between being in the market and what we normally think of an annuity, in the sense of having account growth based off of market performance, but with no downside risk. So every company that offers a fixed index annuity is going to have different crediting strategies based off of different indexes that they have. Every company has an S&P 500 index. That is one of the things that we look at as like the baseline to kind of see what our growth potential is the S&P 500, but there's also Russell's. And then they have some other indexes called volatility controlled indexes that are proprietary to like BlackRock, PIMCO, and some different other crediting strategies. And the main thing to remember is that they're not actually investing in the market. They're not taking your funds and putting it in the market. So that's why they can give us a no downside risk. And then with that, you have what's called like caps and participation rates. And we're going to go into a little bit more with the caps and participation rates and kind of show you how that works. Again, fixed index annuity is going to have the growth potential that is tax deferred. And so we don't have to worry about, paying income tax on that growth on a yearly basis. And the fixed index annuities right now are really popular when it comes to the index, the riders that we can put on there that are going to guarantee future income. Those are riders that we can add that are going to guarantee that lifetime income. We can do even joint income with our spouses. And so it's going to have a spousal continuation with no reduction in the event of a death. Most fixed index annuities are going to come with no kind of fees associated with those. If we start adding those income riders, there tends to be fees with the income solutions. And then with the fixed index annuities, Carly touched on it with the MIGAs, you have like 2, 3, 4, 5, 6. On the indexing side, they're usually confined to 3, 5, 7, and 10-year type products that have a surrender charge. So the surrender charge is, again, if we're going to fully liquidate that contract before the end of that term. And if we don't have the income solution on there, we're still going to have those 10% free withdrawal provisions. So you can pull that fund or have some liquidity and pull funds out as we go along.
Awesome. And then Rhett, you mentioned, crediting options or, strategies here, with a MIGA, you've got your, your rate locked in. Let's spend a little bit of time walking through what, interest accumulation looks like inside of a fixed index annuity.
Yeah, so what we're illustrating here is like the gains in the market compared to, and we're using the S&P 500 because that's kind of the benchmark again that I mentioned, with like the indexing strategies. So as you can see the S&P 500, and we're looking at a time frame between 2016 and 2022, and the S&P returns. And so we're seeing the S&P at 9.45, 19.42, and then a drop in 2018 of negative 6.24. You know, if you're in the market and actually in like a mutual fund that's based off the S&P 500, your account value is going to go down during that period of time. Again, when we're talking about indexes, your floor is 0, indexed annuities. And so as that goes up, I kind of use the analogy of it looks like a staircase. And it simply does look like a staircase. So, you know, we're always protecting your gains plus your principal. That's why on the good years you go up, and on the bad years you stay flat. So you can, as we're looking at that, we'll kind of touch on the different crediting strategies. And so you have like a point-to-point cap. Colin, I think if you go to the next slide, it's going to highlight what that looks like here. Yep. So point-to-point is the most popular. And what that's saying is the day that the contract goes into place, they're going to be looking at the S&P 500. And that is your baseline. And if that goes up, and you have a 7.5% cap and it goes up by 5%, they're going to credit your account 5%. If it goes up by 10.5, well, you're going to get a 7.5% because we're going to hit that cap. Again, with any of these strategies, whether a point-to-point cap or participation, if the index goes down and it's a negative return, you would just stay flat and there would be 0 credit to the account, with, again, no fee associated with that. So your account balance would stay the same. Going down to the next one with the participation, that is simply saying whatever that index returns, they're going to credit your account. In this example, it's 80%. So 2016, the index went up by 9.54%. They're going to credit your account 7.63%. So whatever that index returns, it's just simply 80%. Again, just to kind of point out, I guess, if it is a negative return, you would just get a 0% credit. You can see that in 2018. Next, with the point-to-point 3% spread, that's just saying whatever that index returns, they're going to keep 3% of that. Because they're giving us that protection of the 0% floor, they get to share in those gains. So if it returns, again, 2016, 9.54, they're going to give us 6.54. And then again, the last one here is called a performance trigger. Those have been really popular lately. What that is saying, as long as that index returns 1 penny, so it's a positive gain, they're going to guarantee us 7%. So that's a really nice feature that we can have, and you know, give us those secure gains that we know is kind of set as long as it's a positive return. There's also some other things that that I'm going to touch on here a little bit later with like cap rate locks that some of the companies have to offer.
And then Rhett, can you really quickly to talk about, you know, allocating your money across these different strategies?
Yep. And so when we talk about a point-to-point, those are usually 1-year point-to-point strategies, meaning they're looking at, again, the day that the contract goes into place, 1 year from that date, like the anniversary date of the policy. They do have some other index strategies that go out 2 years or 5 years. But with that being said, that is not something that's stagnant. We can continue to modify that over the life of the contract. So if we, you know, see that there's other opportunities to be had inside of that annuity each year, we can reallocate those funds. Maybe we're in the S&P, but we want to move it over to the crediting option based off the performance from the Russell's 2000. We have that flexibility, and that's where it's really important, you know, working with an agent that is going to be on your side, making sure that we're keeping track of that and maximizing the return potential on these products.
Awesome. So Rhett, walk us through, you know, a couple of the more popular products or, fixed index annuities that you like and why?
Yeah, so these are three companies that are really popular right now. We have Allianz, Ocean View, and Mass Mutual Send. The way that these are written right here, these are products with no fees associated with them. They're really built for accumulation and that tax deferred growth on the policies. And each one of these companies has like one unique thing that really kind of stands out for their products. And I'm going to touch on those here real quick. So Allianz, really big player in the annuity space. They're actually the largest annuity provider in the US. They give us some really good features on their products, really steady growth potential. One of the things with those caps and participation rates is they can change over time. So just because like Allianz right now has an S&P cap, again, the S&P is what we use as a baseline to really measure what our growth potential is. Their cap right now is at 8.25. That is something that's adjustable, but we really monitor that to make sure that we're putting our clients with companies that have a really strong track record of keeping those caps and participation rates at or above what we issue the contract at. And then also one of the other things that Allianz does that is kind of unheard of is anything with a participation rate underneath their contract, you can actually go in and set rate locks. And so there's a couple different things that you can do on those policies throughout that crediting strategy of a 1 year, 2 year, 5 year crediting strategy. Is if you see a really good return on that product, you can simply go in and say, I want that, and simply click a button and it's going to lock in whatever that return is. But then above and beyond that, you can actually set a floor. So if your index strategy is say like at 12%, and we're halfway through the year on that crediting strategy, and we want to say, okay, we want to take advantage of continued growth, but if there's a downturn, I want to lock that in before it drops back down to 0 potentially. And so you can put your floor at 12. So you can continue to take advantage of the higher growth potential for the rest of that term. But if there's ever a turn in that and it starts to drop, it's going to automatically lock you in at 11%. And then at the end of that year, let's say that happens at month 9, at the end of that 12-year period, you can reallocate those funds and redeploy those assets into another crediting strategy that we can continue to monitor and really grow that asset. The worst thing that could happen is you get to the last 2 months of that crediting strategy and something completely out of our control, it's market related, drops that index and you lost all your gains. So Allianz again is one of the companies that have a rate lock feature, excuse me, not a rate lock, but a gain lock feature in the policy. Ocean View, one of the things that they do is they're giving some really high guaranteed fixed rates. So inside of fixed annuity, you not only have the index strategies based off the S&P 500 or other indexes, but you also have a fixed account. And with a fixed account, it's just going to be a guaranteed rate of return for 1 year, essentially is how that works. And they're going to set that fixed rate bucket every year based on the current rates. Allianz does this to some extent. They're up at 7.5% guaranteed for year 1. Now, Ocean View goes all the way up to 10% guaranteed for year 1. So, what a lot of people are doing on that product is, again, year 1, putting all of the money into the guaranteed fixed bucket for year 1, getting a 10% credit. And then again, we kind of reconvene at the end of that year, look to see what we think is going to go on in the market. If we want to, move some of the assets over to a crediting strategy based off of the Russells or NASDAQ or the S&P, we can certainly do that. One other thing is your indexing strategy, we can have it in several different buckets. So you can have 50% in the S&P, 50% in the fixed, or 30% in the S&P. All it has to do is add up to 100%. And so that gives us a lot of flexibility, and that's with all indexed annuities. And then Mass Mutual, We do a lot of work with them, obviously a really big kind of name brand recognition. Their caps are a little bit lower. So their cap is 7.5 on their S&P 500. But one of the things that they do, earlier I mentioned that insurance companies do keep the right to change that cap rate throughout the life of the contract. Again, we're always trying to put in our clients with companies that have a very strong reputation of not lowering that over time. But Mass Mutual actually gives us the ability of whatever we start that contract with, and as long as we put it into, again, I kind of use the term bucket, the bucket of the S&P 500 with the cap lock, we can actually lock in that cap rate for the length of the contract, which is a really nice feature to have. The only downside to that is, again, we can move money out of that bucket of the rate lock, but we can't move money back in. So if you start out with 50% in there, and then next year we take and drop that down to 20%, that 30% that we took out, it can never go back into that rate lock bucket.
Thanks, Rhett. Let's walk through like a hypothetical, illustration here of how these products perform.
Yep. So this is a client that we put in place, or a policy that we put in place for one of our clients. Came to us with 350,000. This is a straight accumulation annuity. This is actually with Allianz, and this is an asset that they didn't need access to those funds. So we just really wanted to continue that tax deferred growth, and it was more of a legacy type product. Again, having that flexibility of pulling out 10% in the future if we needed to pull out some funds from that. But as you look down that, again, 350,000 goes in, and we can kind of see how that end of year crediting, where we got 7.32% for the first year. And then we go to year two, right? Year two was probably a negative return in the market, and so nothing was credited to the account. But as you can see, that $375,616 stays the same. Again, having a product with no fees and no downside risk, there's no harm in that. Next year, 7%. And then we go to 17%. And somebody may say, how do we get a 17% gain when we're talking about index strategies with a 7.5% cap or 8.25% cap? And that comes off of those volatility controlled indexes. They have some really nice growth potential. They have participation rates up in the 250% participation. So whatever that index returns, that is going to give you 280% of that. So that's where we see some of these big jumps. And again, main thing I want to point out here is even on the down years, it's just a 0% credit. All of the gains from the prior year are locked in, as well as safety of that principal. One last thing I want to touch on, this is a 10-year contract. So again, 10-year surrender charge. But at any point with this policy, if the owner were to pass away, that end of year accumulation value goes to the beneficiaries with no penalty. So they are able to take those funds out of that contract and do with that, what they want to do.
That's great. So let's focus. We've talked about accumulation, annuities here, MYGAs, fixed index, goal here, kind of growing account value. Let's switch gears into the other category and start talking through income-driven annuities.
All right, so we'll start with the SPIAs and the DIAs. The main difference between these two products is when you're taking the income. So with a SPIA, it's a one-time upfront lump sum payment, and you start those payments typically immediately, but you do have to start them within 13 months from the date of purchase. With both a SPIA and a DIA, you have access to a lifetime income payout. You can do a period certain for a certain number of years, or you can do life with a period certain, just to mix the two. With a DIA, you can make multiple payments into those policies. And you can defer the payments. However, you do have to, at the time of application, determine when you'll be starting those payments, and you are contractually obligated to start them as the policy has been issued. With both of these products, there is no access to cash value. Once you give them your premium, it is theirs. You are paying for the benefits that you have essentially applied for. So with a FIA, with an income rider, it's, Rhett just went over a FIA. It's going to work the exact same way. However, you are paying for a rider that guarantees you a lifetime payout, either single life or joint life with your spouse. There's nothing in the contract that tells you when you have to start those payments. So there's some flexibility there as well. Enhanced benefits with long-term care. A lot of the FIAs with income right now on the market have a long-term care feature where they'll double your income for 5 years if you cannot perform 2 out of the 6 activities of daily living. So just some long-term care features as well. There's several carriers that actually have products that keep up with inflation. So it's an increasing payout, still guaranteed for life, but it increases each year. We will go over this on the next slide, but a lot of these companies, to juice up that income for you, will give you a bonus in year 1 on your income, and then roll-ups each year that you wait, say 7% for each year that you wait. So there is some incentive to wait to take the income if you're really looking to maximize that. And with a FIA, with the income rider, you still have access to the cash value and death benefit, which, like I said, with the SPIAs and the DIAs, you are giving up access to that cash value. So if you have an emergency and you need access to your funds that's in the policy, you still have some liquidity there as well. And that does the performance aspect of the fixed index. It helps extend the longevity of the contract. Meaning that, even though you're taking out income and coming out of your cash value, being able to participate in performance helps extend the longevity of having cash value within the annuity.
Awesome. Thanks, Carly. I'm sure one of the big questions here is, what does the difference, apples to apples, in between these two products look like when it comes to, generating income?
Yep. So we ran this on it's actually a case study. We had a client recently, he was 64 years old, recently sold his business and wanted to solve for what premium would be needed for he and his wife to receive a guaranteed lifetime income of $180K annually. He wanted to start that income after waiting 3 years. So we ran him a quote with a deferred income annuity and then a FIA with an income rider. Both are the A+ rated. You got Pac Life there on the left and Nationwide on the right. A+ rated companies. Looking at 180K, we ran it for a joint life payout for he and his spouse, a level premium, so it does not increase. With the deferred income annuity, we did run that at a life with 10 years certain. And that one, you'll see it's about 2.7 mil. And then the Nationwide for the lifetime with a death benefit, FIA with a rider, it's about $700,000 cheaper to go that route. And you still have access to your cash value and death benefit.
Awesome. Thanks, Carly. So on the topic of case studies here, Rhett, take us through, several different recent client experiences, what they were specifically trying to, solve with their money. Again, every client is a little different in terms of what they're looking for, what their goals and objectives are. But walk us through a few, recent situations. Oh, Rhett, I think you're on mute.
Yep, sorry about that. First one that came that we're going to review here came to us and had their IRA that they have established and looking to bridge the gap for the next 5 years before Social Security kicked in. They wanted to defer taking Social Security, so they're maximizing that. And then they also had some other deferred income that was going to come in from their prior employment. And so what we looked at doing was putting in a guaranteed income solution that's also going to preserve the original amount of the funds that were going in at the greatest capacity. And so if you go on to the next slide here, Colin, again, we put in $1,150,000. And this is going into that MIGA or that fixed rate solution. So not the FIA with the guaranteed income for life, because we're only trying to plug that gap for 5 years. And this product had a guaranteed rate of 5.6%. And if you look at that withdrawal provision, it allows us to take up to 10% of the account value out every year with no penalty. And so what we proposed in doing is, okay, let's put that money in there. Let's pull out that 10%. And you can see that withdrawal then at year one would be $115,000. Based on the 5.6 guaranteed rate for the interest, it credited back the account $61,180. And so we did that for 5 years. You can see the income does go down a little bit because the account value is going down slightly. But this client was able to pull out $523,640 and still have over $900,000 left over that they could still have that asset to, put into another annuity, move it back into an IRA, however they wanted to do that, but, is able to bridge that gap until those other income streams were able to come in and not commit them to, a lifetime income stream.
Awesome. And let's talk through, I know we've got another case study here. You mentioned kind of plugging the gap, but like laddering different annuities.
Yeah, so obviously one of the big things that we're seeing now is, and people are, obviously talking about is inflation and what that does to our buying power or to that benefit that we're receiving from the annuity. Some people, kind of look at a product and say, I want all of my money up front because, I plan on going on vacation over the next couple of years and I want my money now instead of, relying on a product to increase over time. But, with inflation being as high as it is now, there's some really creative things that we can do with an annuity. And so this client came to us again, looking, having about $300,000 that they wanted to plug the gap with the retirement. And so what we did is we proposed splitting up that $300,000 into 2 different cases. So if you go down to the next slide here, Colin, if we were looking at the highest paying solution from day one and putting all of our per se eggs in one basket, I got the notes here. It paid out $36,817 a year. And that would have been a stagnant benefit for the rest of their life. And so what we proposed doing, and this did have a 5-year wait because they were wanting to start that income in 5 years. What we proposed doing is take 100,000 of that and put that into a product that does increase over time, which is going to lower our upfront payout. In this case, it lowers it to $33,182. So we're essentially leaving, call it $3,000 on a table every year. But then you can see how that product off the $100,000 starts to increase over time. And so by the time that client got to 75, now their yearly income would be $40,300. And by the time they're at 85, now we're up to $53,705. And that is if we start both of those products at the same time. Also, the other nice thing, we didn't do it on this client, but the nice part about having 2 income annuities is you don't have to start them at the same time. Whereas if we have all of the money in an account, we can't just turn on part of the income solution on part of the funds. It's all or nothing once we start that income. But if we're with 2 different contracts, we can stagger those or ladder those start dates because we have those roll-ups and the increasing payout every year you wait to start the income, which gives us a lot of flexibility.
Awesome. Let's get into one where we've actually replaced maybe a subpar product with a better one.
Yeah, been really popular last couple months, going back probably almost the last year. Sometimes people call them like premium refinancing or annuity refinancing. But when we saw rates really jump up over the last 12 months, we've been able to actually replace policies even with incurring a surrender charge and purchase a new policy with a guaranteed income solution. So I had a client come through And the initial conversation was purely, hey, I just left this current employer. I have $160,000 in this IRA. I already have another annuity, and I'm really enjoying this guaranteed income. But I got this other 160,000 that I want to put into another guaranteed income solution. And so by asking a few questions, I was able to figure out how much money was left over in that other annuity, what the surrender charge was, what we're actually going to get from that contract. And we're able to get like an additional 500, or actually, no, it's $1,000 more per month by simply replacing a policy that he'd actually been taking income on for the last year and a half. So even after incurring those surrender charges in that case, and just simply moving it to a higher paid out annuity, and in this case, it actually stayed with the same company. We didn't even have to change companies. It stayed with the same exact company. We just moved it over to a new contract. We were able to increase his pay on that. That's not taking into account the 160,000 and the additional $1,000 a month. It was simply just going and redeploying that original 400,000 that he had from the first annuity.
Awesome. So on the topic of income-driven annuities, Carly, talk us through like what do payout rates look like today?
Yeah, so we did put together a couple of different scenarios. This is a single life payout, putting 100K into the policy. We did a couple of different ages, 55, 60, 65, and 70. We wanted to show, the incentive to wait. I had mentioned some bonuses and roll-ups. That's where that comes into play. If you want to take income immediately, we'll pick 65, for example, you're going to be receiving about a 7.9% return on your investment, guaranteed for life. However, each year that you're waiting, if you wait 5 years, each year that you wait, you're essentially increasing your return by 1%. So you'll see, if you wait 5 years, a 65-year-old, you're going to be getting about a 13.1% return on your investment. So, and again, guaranteed for life. It's just those bonuses and roll-ups. They really help juice up that income and make it a little bit stronger. We did want to show what a higher premium would look like as well. So Colin, if you want to go to the next, yep, here we go. So we did a $250,000 premium as well. Here you'll see the incentive to wait. It's, the same as putting in 100K. It's pretty linear, but every year waiting 5-6% more on your investment it's a really strong return. So you'll see age 65. It's going from 7.9% if you start it immediately and bumps up to 13.1 if you wait the 5 years.
Awesome. And then how do we talk about, when you're looking at annuity companies, obviously a lot of different insurance carriers out there that operate in this space. What are the things that people should be looking at as they're gathering quotes and they're figuring out whether this is something they should do?
For sure. Yeah. A lot of factors go into us evaluating these companies that we work with. It's a very common question. You want to put your money with someone safe, right? So we do use the rating system with AM Best is the most common to assess insurance companies, but there's also Moody's, the Standard & Poor's, and Fitch. Those ratings just really tell you what their financial strength is like. There's different levels to those ratings. We take into account how many years the company has been in business and their reputation. Reputation is huge. We look at their customer service history and their customer service reviews. We want our customers to like the company that they're working with. So that's really important. We work with a lot of different carriers. It's our job to make sure that we are recommending really credible carriers for our customers to be working with. So, a lot of these name brand carriers such as Pac Life, Nationwide, Prudential, they're very well known. They're popping up on your TV every now and again. So not all of the companies that we work with are, these huge name brand companies. It doesn't mean that they are a bad company, but we definitely do our due diligence to make sure that we are recommending them and that they have strong financial backings. Oh, Colin, I think you're muted.
Thanks. Lastly, before we jump into opening this up for Q&A, Rhett, kind of walk us through, an annuity is not right for everybody. How do you go through the process of, deciding is this something that you should put a portion of, your net worth, your money, IRA, cash, whatever it is into a product like this?
Yeah, these are kind of the bullet points that we always hit with every one of our clients when we get on the initial call with them to really kind of understand and nail down what they're looking for. Are they looking for income? Are they looking to, solve that market exposure? What are they trying to accomplish with an annuity? You're right. So, I talk to clients all the time and find out that annuities aren't the right thing for them. And so, working with an agent that understands exactly what you're looking for, and to determine, the best product that fits that. As a independent broker, like Colin mentioned earlier, we're not tied to any one single company. And so we take that information that you give us on that initial call. We kind of go to the drawing board. We work as a team on a lot of cases to figure out exactly, what is the best solution that fits what our clients are looking for, and then come back to our clients, present that in a way, excuse me, that makes sense to them. Again, whether they're looking for income, whether they're looking to, solve a long-term care need, whether it's estate planning, and passing money on to beneficiaries. Knowing exactly what their clients are looking for is our number one goal, so we can pair them with the right product.
Awesome. Thanks, Rhett. So we wanted to leave, some time here for Q&A. So in the chat, in the webinar feature, should be at the top or off to the side there. If you have questions, please put them in there as they start to populate. I'm going to dish them out here. And in the meantime, as we're kind of going through this, if you're interested in meeting with the team here on just furthering your exploration of annuities, how they work, if it's suitable for what you're trying to accomplish, drop us an email at hello@leverageplanning.com, or put it in the chat as well, and we'll follow up with you. And so Rhett here, the first one, I'm gonna pass this one off to you. Are annuities FDIC insured?
Yeah, that's a great question. We get that all the time, and the short answer is no. They are not FDIC insured. They are backed by the state that you're in, based on that carrier, that insurance company being an admitted insurance provider in your state. We only work with admitted carriers in these states. Most of the companies we work with are able to do business in almost all 50 states. And depending on the state that you're in, that's either going to be backed to 250,000. There is a handful of states that go up to 500,000 of that annuity backing by the state.
Awesome. Thank you. Carly, I'm going to pass this one to you. Looking for clarification on the fees. Which annuities have fees, how they work, and as specific as you can be.
Yeah, so the MIGAs and the fixed index annuities, those are products that do not have any fees on them. When we were talking about the fixed index annuity with a rider on it, as I mentioned, you do pay for those lifetime benefits. Most companies are about 1 to 1.25% annually against your cash value. So it doesn't affect the income, but yes, there is a fee on a fixed index annuity that has a rider on it.
Awesome. And then Rhett, I'm going to come back to you with this one. Is there risk of loss with an annuity?
Not with the annuities that we provide. So we work in that realm of the overarching realm of these annuities are what are called fixed annuities. Fixed annuities have no risk of loss. So whether you're in that fixed indexed annuity that's based off of market performance, there's no risk of loss. MIGA, obviously that's a set fixed rate for that term of insurance, no risk of loss. There are annuities out there that do come with the risk of loss. Those are either going to be what's called a RILA. There is some protection there on your downside, but ultimately there is risk of loss. And then the big one that's out there is variable annuities. Variable annuities not only have a risk of loss, but there's a lot of fees associated with those annuities as well. Most of our client base is looking to get away from market risk and minimize fees. So we've taken the position of the variable annuities probably don't fit most of our clients' objectives.
Awesome. Carly, back to you here. Which states do we operate in?
This is an easy one. We are licensed to do business in all 50 states.
Sweet. Since that was so easy, tax implications of annuities.
Well, this one is dependent on how you fund the annuity. If you fund the annuity with pre-tax retirement funds, it is tax deferred within the annuity. Once you take it as a withdrawal, as income, it is taxable at your ordinary income rate. If you fund it with post-tax money, you will have what is called a cost basis. So when you take out any withdrawals, interest is pulled out first, and the interest is all that is going to be taxable also at your ordinary income rate.
Cool. And on the topic of taxes, we're kind of in the same vein there. Can I use a 401k for an annuity? And are there taxable events when moving that money? Rhett, I'm going to throw that back to you.
Okay. Absolutely. I would say the vast majority of annuities that we're working with is coming from 401ks, IRAs, 403bs, different retirement plans that people have through their employers. And we move it into an annuity that is an IRA, so we can continue that tax deferred growth. There is no taxable implications on making that transfer. So that is a very easy thing to do. And again, the most common form of the funds that we're using for that are going into those annuities are coming from the term that's kind of used in the industry is qualified money. Qualified money means it hasn't been taxed yet. And then you have non-qualified money, which would be, simply from like a checking or savings account or post-tax dollars.
Awesome. And then Rhett, I'm going to leave this last one here with you because I know you've had a lot of cases specifically dealing with this. But which annuities can help cover for long-term care?
Yeah, so Carly mentioned earlier that there's the enhanced payout on some of those fixed index annuities with the guaranteed income rider. That enhanced benefit does increase that depending on how we have it set up, but up to double your payout for a long-term care type event with increasing that payout for up to 5 years. When we're talking about, getting $20,000 a year and then going to 40, that's probably not solving the long-term care need per se. It is a nice added benefit that on those products that comes at no additional charge. It doesn't reduce your overall income, but it's just kind of a side benefit that those policies have. There are true long-term care annuities that are extremely popular. If anybody's familiar with traditional long-term care, think of that as a use it or lose it type scenario. Same with like car insurance. You can pay your premium into that, never have a car accident, and you pay that premium for nothing. With a true long-term care annuity, it is going to have growth potential as the money's sitting in there. But then also if you have a long-term care need, it leverages the original premium that you put in there. So the most popular plan leverages it by over 3 times. It's actually 305%. So you put in 100,000, it's going to give you $315,000 in true long-term care coverage. But if you never use it, whether you take the money back and surrendering that policy, or you keep it until you pass away, that money is either coming back to you or it's going to your beneficiaries. It's not a $500 a month premium that goes to the insurance company. And if you never use the policy, or, sometimes we see on long-term care, you have like a 90-day elimination period. Think of the elimination period as like your deductible. So you would have to be in that long-term care facility for 90 days before they start paying that out to you. And, unfortunately, if you don't make it the 90 days, that traditional long-term care policy doesn't pay anything. And on the annuity, there would be the death benefit, and that would be your accumulation value. So if you put in that 100,000, not only you get the 315 towards long-term care insurance, but that 100,000 is going to grow risk-free. So nothing in the market would drive that down. But if you have that policy for 15, 20 years, that 100,000 is realistically going to turn into 200, 250,000 in a death benefit. Or maybe you get to 80 years old or whatever the case may be and no longer need that long-term care. You simply surrender that policy. Not only you get the original premium back, but you got all those gains back as well.
Awesome. And then last question we just had coming in. What is the advantage in using leverage versus going direct to the providers? And Rhett, I'm going to have you take
Yeah,
that.
I'll take that one. Number one, usually you can't go directly to the providers because you have to go through a licensed agent, broker, to buy these products. And you know, a lot of times I hear, and I've been guilty of this myself, and you know, searching for car insurance or homeowners insurance is, you know, can I cut out the middleman? And boy, do I get that. You know, I buy insurance just like anybody else does on my home and my cars and other, you know, things that I'm insuring. And unfortunately, even if you can, and in those scenarios where you can buy directly from the provider themselves, they're charging the same amount. And so not only are you paying the same amount, but you're getting the same product back with no guidance. And so, you know, I've always taken the approach, Colin and Carly have also taken the approach, is we're not pushy salespeople. We are compensated for what we do by the insurance company. There's no fee that goes to you to, you know, cover, you know, what we're doing on your behalf. And we're your point of contact for as long as you have the policy. So, you know, I tell every one of my clients, I never expect you to call Allianz. I never expect you to, you know, call Ocean View or Mass Mutual. You have to call a 1-800 number and sit on hold. That's just the world that we live in. Whatever company you're calling, you're sitting on hold because of the business that we do. We have a direct line to every single one of these carriers. My average hold time is probably 45 seconds at most. And if it's something that we need to get the client on the phone for, I get the insurance company on, conference the client in, there's no hold at all. And so I think that's the value that comes with working with an agent. At the end of the day, you're getting the same product at the same cost or the same benefits that are coming to you, but you're getting that guidance throughout the life of that policy.
That's great. And Rhett, I'm going to add one more quick thing in there too. If a carrier changes rates and you have the ability to get into a higher yielding product, how often is the carrier going to come to you with that?
I mean, I'll answer that question, never. You know,
Yeah.
we have clients that have been in a contract for 20 years and they just now looked at it. In the last 10 years, they've been at 1%. That is what's being credited to their account. And they didn't know any better. You know, whether their agent that they bought it from is no longer around, you know, they may have retired themselves. But the carriers are certainly not coming to you and say, hey, you know, even we have another product that we could get you into. Yeah, that doesn't happen.
Cool. Well, hey, we're coming up on time here. Just to kind of close us out here, next steps. If you're interested in learning more about these products, you want to chat with our team, like Rhett said, we're not pushy salespeople. You know, we'll tell you whether or not we think an annuity is a good fit for you, but you're welcome to meet with our team to learn more, get some personalized rates. We put together recommendations into a packet that we have here that we'll email to you. Can also ship it out to your home. When you go through, this isn't something that we hit on earlier, but when you go through the process of applying for an annuity, those funds go directly from whoever the custodian is over to the annuity company. We don't touch your money. You don't wire anything to us. You don't send us a check. We help facilitate that process. But that money goes direct to the carrier. Typically takes 2 to 4 weeks to activate an annuity, depending on the source of funds. You know, some custodians take a little bit longer, you know, to release those. But like Rhett said, the value in working with an independent broker like us is we're on top of it. We know what the market's doing. We know whether there's opportunities to get into higher yielding products. We're on top of the servicing requirements. That's not what you get when you work, you know, directly with an insurance carrier. But to close this out, I really appreciate everybody jumping on today, you know, learning a little bit more about how these products work, what payouts look like today. We would be more than happy to spend time with you exploring these products. Just shoot us an email at hello@leverageplanning.com. You can also go to the site, go through the process of filling out your information and scheduling a time with a member of our team. So again, thank you so much for joining us. Oh, yep, Rhett.
Oh, yeah. There was one other question that I see came through when we were talking about performance triggers, and I'll address that here real quick. So the question is, do you buy a performance trigger? Again, there's no fee to buy the performance trigger, but usually what the performance trigger is it's 1% less than the normal point-to-point cap. So for example, if the point-to-point cap is at 8%, the performance trigger is going to be at 7%. So there's no cost associated with it, but if the index goes up by 10 and you're in the performance trigger, you're going to get 7. Whereas if you were in the normal point-to-point cap, you would have got the 8%. So you would have got a percent more. But, you know, the trade-off with that is if it's, you know, 0.5%, you get 7. Whereas if you're in the cap, you would have got 0.5%.
Awesome.
So
Well, again, thank you.
Sorry,
for
we didn't address that earlier.
Yeah. Thanks for your time. Thanks for joining us on a Wednesday. Again, reach out to our team if you have any questions. We appreciate it.